All right, Andrew, thank you. It is time to talk about your money right here on Good Morning Quad Cities. And first, let's take a look at how the stock market is doing at the end of last week's trading. Things were down. The S&P 500 down over 3%, NASDAQ down almost 4%. Dow Jones was down 3% as well. So joining us is our financial expert, Mark Grywacheski. He is from the Quad Cities Investment Group. Thank you so much for coming in this morning. A lot to get to this morning, a lot to talk to.
Certainly is. Good to see you again. Happy Monday.
Absolutely. Glad to have you with us. So it seemed that Friday's sell-off was triggered by maybe panic on Wall Street. What was the Fed Reserve? What were they reacting to?
Well, I think we do have a graph coming up here, but I think here we go right here. And we can see, the end result of Friday's, heavy sell-off. I did check a couple of minutes ago the initial indicators for the opening. We are set to open, another 1% lower. We'll see how things pan out over the next couple of hours, but once Wall Street officially opens up at 8:30, but it's not looking good for today's open. But to get to your question, the Federal Reserve is trying to engineer what's called a soft landing. In other words, to get this very high level of inflation under control, the Federal Reserve wants to raise interest rates, but in a way that doesn't, cause a lot of pain to the U.S. economy. But on Friday, Federal Reserve Chairman Jerome Powell stated that the Federal Reserve's #1 priority is getting this inflation under control. So that means that the Federal Reserve will keep aggressively raising interest rates, even if it causes some level of pain on the U.S. economy.
Some level of pain. They're going to keep raising interest rates. This is going to affect the housing market, credit card scores. I mean, using credit cards as well?
Well, the Federal Reserve realizes that this current level of inflation, simply isn't sustainable. We see the punishing impact this inflation has had on Americans, especially, low income, retirees, but even the middle class. This high inflation is costing the average American household an extra $5,500 a year in higher costs. And we can't have Americans, or even force Americans, to choose between, their housing or food or clothing just because prices are just so high now. So the Federal Reserve feels like it's almost being, pushed into a corner. This high level of inflation, again, is not sustainable. So the Federal Reserve, in a last-ditch effort almost, is just going to keep raising interest rates until it gets this inflation under control.
I can hear people at home saying right now, salaries are not keeping up with that $5,500 that you were just talking about a year, that it's costing all of us at home. So in your expert opinion, how long will the Federal Reserve continue to raise these interest rates?
Well, again, until it sees some type of evidence that the inflation is going to hopefully start to decline.
Does this mean recession?
Well, technically, we are in some type of recession. We have seen 2 consecutive quarters of negative economic growth. But the problem is we still have, I wouldn't say it a problem. The good thing is, though, we have a very strong labor market. Manufacturing, consumer spending still remains very strong. The concern for me, though, is not so much now. It's 6 to 9 months down the road. And that's because it's going to take 6 to 9 months for these, inflation or these interest rates to work their way through the economy. So again, for me, it's end of this year, the first half of next year in 2023, when I think those recessionary concerns start to pop up.
Mark, always good to have you. Thank you for joining us early on a Monday morning.
My pleasure. Good to see you.